Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the man himself, the legend, Mr. Michael Becker.
Hey, Paul.
How are you?
Good. How are you?
I'm doing well. And also sitting in, James Eng, the professor.
Hey, Paul. Thanks a lot for having me.
James, how are you?
Great.
Good. So I'm going to ask James, what's going on in the Old Capital world these days?
I mean, the closest incoming event we have is Wednesday, April 3rd over at the Grapevine Convention Center. We're bringing in Mark Dotzauer. So he used to run our chief guy over at the Texas A&M Real Estate Center. And so we're bringing him in to speak to 400 or 500 of our closest friends.
And how do people get more information concerning to RSVP to get on that list?
Yeah, so please RSVP so we make sure we put out a chair for you. Go to oldcapitalpodcast.com, and register there.
Two things that we don't say enough is that if you like the content of the information that we provide in the Old Capital Real Estate Investing Podcast, go back to iTunes or Stitcher and give us a 5-star rating. We would definitely appreciate that. That moves us up in the rankings. Again, only if you think that we provide value and good educational quality about what's going on in the apartment industry. So what is going on in the apartment industry? I think that is probably the key question that we have today. So we have one of the premier educators, premier chief economists, premier guy in the absolute know, Greg Willett from RealPage. He's the chief economist. He's going to sit in and talk with us a little bit. And he brought one of his guys that also from RealPage. Tim, thanks for coming in. We appreciate hanging out with us here.
Yeah, thanks for having us.
So Greg, if you're not familiar, do me a favor, go do a Google search under Greg Willett under RealPage, and you will figure out that he is the guy that everyone quotes throughout the United States, just not here in the Texas area, but throughout the United States. In fact, I was just received an email from a buddy of mine up in Denver that sent me an article, and he said, hey, listen to this article. It talks a little bit about the Denver market, some great information. And the person that they quoted in that article, Greg Willett.
Well, Paul, I just never stop talking, I think is the storyline there.
I think for people that don't know, this guy has a photographic memory. He does everything without notes. I think he's half robot, but he is definitely in the know. So before we get going on, Greg, I want to kind of figure out a little bit how to talk a little bit about RealPage. RealPage is a technology company that both Greg and Tim work for and are associated with. But Tim, tell us a little bit more about RealPage and what you do for RealPage.
Sure. So my name's Tim Teat, T-E-A-T, Tango, Echo, Alpha Tango. Yes, that is how I learned how to fight in junior high. And RealPage, I've been with them for a few years, so I'm a senior manager on the sales team here. And it's an interesting story about RealPage because we do so many different things. It's hard to just say we're a technology company or we do financial solutions or software. So really, it's better to just kind of tell the story because we started about 20 years ago. And at that time, it focused around software. So for those of you, and I'm dating myself a little bit here by saying this was back in the days of DOS, where you actually put software on a disk and gave it to someone in that format. But when all of our competitors moved to like Windows 95 and 98, RealPage already saw the value in moving all these kinds of solutions to the cloud. And in doing so, over the past 20 years, have created data streams that aren't available anywhere else. And the customers and clientele of RealPage, from passive investors into multifamily to actual corporate owners, institutional owners, management groups, and brokers, they all benefit from leveraging this big data that we use through a myriad of different solutions to appreciate the value of their assets. So it's an equity gain by appreciating the operating income of the properties, reducing their costs to operate, and allowing them to know how they can benchmark the operation of their property versus their competitors. And so in doing so, I mean, let's be honest, real estate investing can be considered kind of risky in certain aspects, whereas if you've got a real conservative municipal bond or something like that, the reason you go for the better investment is because of the higher return. And even nominal gains of equity, of NOI, on these kinds of properties can yield big dividends and returns for those investors. And so that's kind of what RealPage does, is creates innovative and simple solutions that investors can use to appreciate the value of their assets, whether that be operational software, payment systems, insurance, all that kind of thing.
What are some of your products or major products that you guys have in the market? Because most of the stuff is not branded RealPage, but maybe some of the property management software. So maybe some of the stuff that somebody would see.
Sure.
If you could mention some of those and then also what they do.
Yeah, absolutely. So, I mean, it depends on the vertical we're talking to. So, for example, I know a lot of your listeners are probably passive investors that are involved in syndications. The most successful syndications use the data that RealPage provides through our platform called Axiometrics, as well as all the things that we've done for years with MPF research. It gives you granular details on a monthly basis of what's going on in the market from a pricing perspective, and all kinds of other interesting information like the jobs market. And the reason this data is valuable is because it's third-party unbiased, whereas if you get your data from a broker, they've got a vested interest perhaps of which property they want you guys to go with. So our data, not only is it unbiased and incredibly accurate, but it has highly accurate 5-year forecasts. So if you've heard of Axiometrics, you've probably heard about it from a really effective strategic investment group. But our core competency that we're most popular for is probably our YieldStar and LRO, which are revenue management platforms, which automatically price out your individual units and multifamily on a daily basis based on what the market will bear. Similar to what you'll see like when you buy plane tickets and you notice they change pricing. And what we see when people move to automated pricing like that, using our lease level granular data that you really can't get anywhere else, is they're able to appreciate their rent roll 3 to 7% each year, meaning massive gains when you factor in the cap rate and like, you know, if it's financed or whatnot, that if you really increase the equity, it allows you to either refinance and distribute dividends, or if it's more of a long hold strategy, then at the end of the day, you're just appreciating the value of your property.
For somebody to get more information about what you do and what RealPage does, what's the best way for them to get information from you?
Sure. I'm an open networker on LinkedIn. So again, Timothy Teat, Tim Teat, T-E-A-T. And, of course, you could email me at tim.teat@realpage.com.
Great information. Thanks, Tim. All right, let's turn it over to the robot himself, the guy that has all the answers, that does this without notes. This is the most important thing. Does it without notes. He is amazing.
Paul, I'll point out I wouldn't even let you show me the questions before we got started.
He is Mr. Greg Willett, so thanks for coming in. We appreciate that. So I'm going to turn it over to the guys, but I kind of wanted to let's start at the top. Kind of get the macro level of how the United States apartment market's doing, and then kind of work our way down to maybe some individual larger areas, larger towns, larger cities in the country, and then let's transition into Texas and the 4 major rental areas of Austin, San Antonio, Houston, and Dallas, Fort Worth. So I'm going to turn it over to both the Grand Inquisitors, Mr. Michael Becker and James Eng.
So I guess, Greg, maybe give us the national, what you guys are seeing, and then also maybe touch on how the data flows into you. So is it, what percentage of properties are you looking at? Are you looking at all properties? Are you looking at data from, actual properties? Explain a little bit on how the data set comes to you.
Sure. Let's start talking about the data overall. And so it's a giant data set. We're really looking at all the existing product across the country that's really some sort of professional management in place. And a lot of the data does come from the technology systems that Tim was talking about. So we can pull that information out of there directly. So that means I've got a new set of data overnight. So completely up to date. And also when you're pulling information out of things like the property management system or the revenue management system, you can see that things that you can't see just by looking at listings or other ways of collecting data. And I'll give some examples there. You can see whether or not people are renewing leases and what are they paying for renewal leases versus what would be the price for somebody walking in the front door fresh and signing that first lease. We can track a lot about the characteristics of renters who are out there and how that varies by product type and by metro area. So it's a really huge and robust data set.
Before we jump into sort of the national side, do you guys see a cut between sort of class A, B, and C also, or like C properties using your services, or is it mostly sort of your top of line Class A stuff?
Certainly we have across the spectrum, a lot of use of our technology systems. And we go deeper into the A and B space, but still we do have a lot of product that we're tracking that's in that C category.
Okay. All right. So maybe give us a snapshot of the national side, and then maybe if you want to, I know a lot of the people who are focused in on Texas or maybe even live in Texas, they're going to sort of Atlanta and Phoenix. So maybe if you can give us a little insight into those markets as well, that would be great.
Sure. And looking at big picture, certainly something important to realize is this cycle has been running for a long time. We think of it as having initiated this cycle early 2010 or so. So we're way into this. And I hate that question about what inning are we in that you hear all the time, but I think we do need to acknowledge it's probably late cycle. We're certainly closer to the next recession than we were to the last one that happened. And so we've moved a little bit past peak performance for the nation's apartment market. That peak performance probably was 2015 or so. But what's amazing as we've gone a little bit later in the cycle, just how well the results are holding up. So not quite as strong as it was, but still pretty healthy. As we look at national occupancy in early 2019, we're still a little bit north of 95%. So not a ton of vacancy out there to the degree that there are some vacant units. They tend to be those brand new deliveries who are moving through the initial lease up process, and annual rent growth coming in around a little bit north of the 3% mark. So not quite where we were at 5% plus back in 2015, but 3% is still a pretty healthy number. If we're looking at maybe some shifting momentum of late, if we go back a couple of years ago and we started delivering so much new supply, luxury product slowed down on rent growth. But in the past couple of quarters, that's actually come back a little bit. Certainly the properties that are moving through lease up, still giving away a lot of free rent and concessions. But once you get that initial resident base in place, we're able to push rents even in the luxury product.
Why do you think that is? What's behind the change?
We did have a little bit of a lull in completions in late 2018 to early 2019, but still a lot of product coming. But I think that owners and operators got just a little bit more confident as they saw just a tiny bit less moving through lease up.
Is there any wider geographical areas that are doing better or worse from like the Northeast, South, Southwest, et cetera?
And I don't know that it's a regional pattern that jumps out at you, but you certainly do see that performances certainly in terms of rent growth, it's a little bit stronger in the places where you're not building new supply. I mean, the new supply just tends to slow it down. And during the course of the cycle, there are about 15 metros that have accounted for half of the stock that has come online. So,
New York,
yeah, well,
Dallas,
certainly
Houston.
the number one spot is here where we are in Dallas-Fort Worth, where you've delivered a lot more units than anywhere else, and that's going to continue. We've got 36,000 apartments under construction in Dallas-Fort Worth, and the next market on the list has something like between 15 and 20,000. So it's a big chunk coming online locally here in Dallas-Fort Worth.
Before we talk about our favorite market here in Dallas, any comments on Phoenix or Atlanta?
Every time we look at the data, it's Phoenix and Las Vegas trading off the number one spot for overall rent growth nationally. So Phoenix is right at the top. Atlanta is doing well also, and we certainly are constantly monitoring what's happening in the 50 largest markets, even though we track product everywhere. But in those 50 largest markets, Atlanta would be top 10 to 15. So still pretty solid.
How are those markets still having so much rent growth? Is it the lack of supply, or are they just late cycle? They went deeper during the recession and now they're coming back? Or why did Texas have their rent growth in 15 and 16 and now it's
a couple different stories. I mean, there are some markets that are just late recovery markets. They tend to be the markets that got hit hardest during the recession. Took them a little while longer to get their economies on track, to start building again. And so Phoenix and Las Vegas are great examples of that. You're still not building much product in Las Vegas at this point. Construction has come back more so in Phoenix. Atlanta is a little bit farther along, and then Texas is pretty advanced. And it was the first area to come back, and then you cranked up construction so aggressively that you're in the slowdown phase in Texas in terms of rent achievement. So different markets at different phases of the cycle. But even these ones that are getting a lot of new supply, I'll point out, they tend to be the job leaders. So you've got huge demand too.
Okay. Let's jump into maybe the markets here in Texas. Let's start with where I was born and raised in Houston. It seems like it's coming back a little bit, depending on who you talk to.
Yeah. and I would say not so much quite
Yeah.
yet. And let's circle back to 2017. We had the hurricane. There were a lot of people who were displaced from single-family homes that came in and rented apartments right after that. We had a big increase in occupancy and then, in turn, some pretty strong rent growth. Over the course of the past year or so, those people who had been displaced, they're going back to their homes that have now been repaired. Okay. So even though we have some really strong job growth in Houston on net, we don't have much apartment demand. And in particular, that is hurting pricing power. In our first quarter data, annual rent change in Houston there hasn't been any. It's right at zero. Okay. So that's one of the weaker performances you see across the country. But we're not going to deliver much product right away. Yeah. So we do think that we regained some momentum. But right now, Houston's kind of the bottom of the list nationally.
Even though it has the job growth and population growth, it still isn't able to translate that into rent growth.
Right. No rent growth. And certainly those jobs are creating some renter households. You have some demand, but at the same time, on net, not much, because you're also cycling people out back into the single family product.
Okay. Why don't we jump over to San Antonio and then Austin?
So San Antonio tends to be the Texas slow and steady market. It's never off the charts. At the same time, it never seems to stumble in a big way. So you've got okay but not great occupancy in San Antonio, and really kind of the same story on rent growth. There is rent growth there, but it's going to be running a little bit under the national average. It's a normal situation.
So every one of my buddies I talked to that own stuff down in San Antonio all seem to struggle, or at least have struggled the last year to two. Is there pockets, or is it property grade that is doing better than the others in San Antonio? Do you have a sense of that?
To some degree, it's hit and miss, but maybe a little bit different than you would see in other markets. San Antonio is doing comparatively well at the top end of the market, and in most other places, it's going to be the middle to bottom end of the market where the best performances are. But for San Antonio, products is a little bit more affordable, and so I think there are more people who can afford the luxury product in San Antonio. If you have just a decent job in that market, the top tier product's still within reach, which that's not true for these really expensive units that you see in Houston, Dallas, or Austin.
And is it the type of product they're delivering more like garden style walk up versus some of these other markets are more the higher construction costs with the structured parking?
Yeah, I mean, the bulk of the construction that you see across the U.S. and in most of Texas is going to be mid-rise, higher end product. You have some of that in San Antonio, but you can still, in some places in San Antonio, do 3-story product with a surface parking, and that's just going to be a lower price point.
Have you guys been measuring the gap sort of from that Class B to Class A in maybe the 4 Texas markets? And do you see, like, maybe San Antonio, it's only a $200 difference between a B and a Class A?
Certainly that difference between A and B is not going to be as big in San Antonio as it is in the other markets. But nationally, because the luxury product has been so high-end that we've delivered in this cycle, that for the country as a whole, that difference is about $500 a month. I mean, that's huge. And when you get to in select markets, you'll get down to it's about $200. But in most, it's going to be in that $400 to $500 range. Okay.
Why don't we go up I-35 to Austin? And I feel like every month there's a new company hiring more people in Austin. So
and tech companies and their high-end jobs and certainly as you look right now in the marketplace, Austin is the rock star for Texas. It has very solid occupancy all throughout the specter of product. It's a top 10 market nationally for rent growth. You're in that 4 to 5% range on annual rent growth in that one. And again, really seen across the product mix. I have nothing but good things to say about Austin.
Any preference sort of, I mean, a lot of people in the gap between Austin and San Antonio, it seems to be getting closer and closer. Any range, or what are you seeing in terms of Class A stuff there? Because I know in the last cycle, a lot of new supply hit Austin, and so the percentage of inventory was very large. Are you seeing new supply coming, or is it okay in Austin, or is it muted?
Yeah, no, there's a lot of construction that has happened in this cycle in Austin and that is continuing to happen in Austin. Something that really distinguishes that metro, however, is that there's construction. The construction is spread around everywhere versus being concentrated in just 2 or 3 pockets, which, that concentration makes it harder to get it absorbed all at once. But if you spread it around, you can handle a whole lot more product, and that's what we're seeing in Austin.
From my perspective, we own a bunch of product up here in Dallas-Fort Worth, and then we bought a few deals in Austin last year, buying a deal right now in Austin. And it seemed like the pricing had always, on like that kind of for sale, the pricing has always been, 50 basis points more expensive in Austin relative to Dallas and your cap rate. And it seemed like that kind of changed about a year or so ago, and Dallas, like Austin kind of paused maybe in 16, and Dallas kept going, and now pricing is pretty comparable when it doesn't feel like it should be, because Austin feels like a little bit more of a dynamic market than where we sit right here.
I am going to agree that a year to 2 years ago, Austin did just have this brief lull, but has really come back strong, and Dallas has been pushing the whole way.
Yeah.
There's probably, just in general, I would say a little bit more risk in Dallas-Fort Worth just because the construction is so aggressive here and because it is more concentrated than you would see in Austin. But I wouldn't really expect a giant difference in pricing between those two.
Is there any submarkets in Austin that you like better than others that kind of jump off the page to you?
Really, all of them have been doing well. What maybe stands out on that one is versus what you see in other markets, downtown in the urban core is not way off the charts. Yeah. So that is distinguished a little bit just because it's different. But again, there's a lot of places in Austin that look pretty attractive.
Before we go to Dallas, maybe give us a comparison of how big sort of the Austin apartment market is compared to DFW, because I think sometimes people forget
that it's much smaller. It's still much smaller. Right. And so while they've had tremendous growth there, Austin is maybe a third of the size of Dallas-Fort Worth. So, and Houston is bigger than Dallas alone, but smaller than Dallas-Fort Worth combined.
Okay. So let's come on up to Dallas, and we touched on the new supply. Maybe go through sort of A, B, and C for Dallas, and then maybe touch on maybe some of the submarkets that you're seeing pop right now.
Certainly in Dallas, I mean, the performances are pretty different by product segment and by neighborhood. And again, we've had so much construction in this market that we've slowed down rent growth for luxury product on the Dallas side of DFW. And really, when you look at Dallas urban core, and then whenever you get to those far North Dallas suburbs, Frisco and Allen McKinney, and to some degree Plano, you've got pretty much flat rents in those areas. So pretty competitive there. A little bit more momentum, particularly on the rent side, whenever you get down to Class B product in Dallas. And then Class C, you have to be careful because there are affordability considerations as you're pushing rents. But something that is very different in Dallas Class C now compared to what was the historical pattern, that Class C product is jam-packed full. And Dallas is a place that used to have chronic vacancies in Class C product.
So what caused that change from
we just had so much
2009,
rent growth
Okay.
in this cycle that I think people who previously would have been in Class B product have been priced out of it. And so C is what they can afford at this point. So again, those units are really full. And then you go over to Fort Worth, and there's a little bit of a premium over the Dallas performance in every segment. For luxury, it's simply because you've not built as much product in Fort Worth. But that also, the competitive environment that you see when you build a lot of product trickles down into B and C performances. And again, if you haven't built a lot at the top end of the market in Fort Worth, that's going to leave B and C a little bit healthier too. So Fort Worth does get a premium over Dallas at this point in terms of rent growth.
On the Fort Worth side, any insight into how's sort of that Alliance area doing up north and then Chisholm Trail area? Do you guys see anything in those two submarkets?
It's pretty solid across the board in Fort Worth. Maybe the one exception being luxury product downtown, because that's to the degree we've had construction in Fort Worth, it's tended to be downtown. And then really rocking the story across the spectrum, it's those mid-cities markets, which most of them technically are on the Fort Worth side of DFW, but really it's those areas in between Dallas and Fort Worth that are performing especially well.
Is there any new supply in those markets?
Very little, and that's certainly part of the story. There is not much building in those mid-cities markets with, a little bit in Grand Prairie, a little bit in Grapevine, but, nothing in Arlington, nothing as you go a little bit closer over toward Fort Worth.
Okay. And then I guess sort of we're wrapping up Q1 here in 2019. Is there anything that you guys have seen come out of your data that sort of you shook your head at, you didn't really understand why it came out, or anything new in terms of insight that you didn't maybe see last year?
And I talked about a little bit earlier, we did see some return of some pricing momentum in Class A product toward the end of last year. If I'm being honest, first quarter of this year is one of the most boring quarters in terms of data that we've seen in a long time, and that just nothing changed. But, it was already good news. So that's more good news that it just held steady, but there was really almost no movement, not just here locally, but really all across the country. It looks like it did 6 to 9 months ago.
Okay. So I guess crystal ball for 2019 going forward, any property classes or markets that you think are going to outperform in the next 6 to 9 months?
Well, I did say that as we regained some pricing momentum in Class A product, that was because we had a little bit of a lull in construction in the deliveries, and lull was the right word there because those new supply numbers are going to go back up. So we do think that will slow things down a little bit overall, and our forecast really for almost all markets is that as we get later into 2019 and on into 2020, expect performances to cool off a little bit. I mean, we're not going off the edge of the cliff, but not quite at the level that we're seeing right now.
So, Greg, your rich sister called me.
Yeah.
And she said, ask Greg a real quick question. I'm looking for an investment as a passive investor into one of these apartment deals. What's the best area should I be investing in throughout the country? Should I be going in B properties in Atlanta, C properties in Dallas? What do we advise your sister?
Well, I'll phrase it differently than advising my sister, because my sister is mean enough that I gave her the wrong advice. I would really pay for that. So, but thinking about our business, every year we have a big client conference that comes up at midsummer. This year it's in July, and we're going to be in Orlando. And so we're in the process of planning sessions and topics that we're going to be focusing on. And so there are a couple of sessions that I've put together, and that reflects where I think there is opportunity. And so we are inviting in some of the major owners and operators of Class B product to come talk about that niche. I think that is the standout sector in that you look at Class A, there is a lot of construction that's going to slow down performances. If you look in Class C, it's okay and it's going to be really full, but there are affordability challenges with the people who live in Class C. So I think you're going to have some struggle pushing rents. So that means B is probably the spot to be.
So some of the people that are going to come to your conference in Orlando, they're Class C owners. Where are they making positions in?
Again, I'm not saying that Class C doesn't work, but you do have to be careful. And I think as we were early in this cycle, you were buying Class B product and you were going to upgrade it and you wanted to move it up into the next category.
Right.
I think now you might do some upgrades, a little bit of rehab, but you don't want to completely transition this product. You want to keep it at a lower end price point because that's where there's going to be some really strong demand. So if you can make the financials work while not pushing too hard on the rents, that's the attractive space.
Yeah, we've talked about the number of upgrades to these properties that have had through the cycle. It wasn't just once, it wasn't just twice. But working on our third and fourth rehab, recycle of these properties. Now this time they're probably bringing their amenities to the next level. Have you seen? Tell me a little bit about the amenities in these B properties. What are people putting in there on these rehabs today? I mean, some of the things I'm hearing is these Nest thermostats or even cameras at the door. Tell me a little bit about what's being upgraded on these properties.
Yeah, and you've hit what's probably the most popular category is electronics and technology that increase the functionality and just make it a more updated, more advanced place to. It's stuff that the residents can see and will use. It's not about how shiny and pretty it is. It's give them something that's functional and is going to make their life operate a little bit better than maybe it would otherwise.
Yeah, Mike, what's your take on that? I think a couple of the risks is that people are always using these smartphones and they love Ring when they can see what's outside their door. But I think some of the problems is that is this technology going to be around 5 years if you choose to go Nest or you choose to go Ring?
Yeah, one of my mistakes in life is getting those Ring doorbells. Now my wife knows exactly what time I got home from the bar, right? So they'll come back and bit me once or twice. But in all seriousness, yeah, we're all creating a nanny state, not to get a paranoid libertarian on you, but everyone's going to spy on us. So I think it cuts both ways a little bit with it. I think the Nest stuff works fine. I think I'd be a little bit more careful about the cameras and things like that because you might have some unintended consequences that come back to that. So, but yeah, that's certainly something that we're starting to put in a lot of our deals, and you just kind of watch what the big developers are doing and do what they do.
So, what are you seeing in some of these brand new developments that are going up? Because the C's kind of follow what the B's are doing, the B's kind of follow what the A's are doing, just to kind of get these amenity packages, brand new little bells and whistles. What have you seen?
So, I mean, in terms of amenities at the luxury product, man, it's just everything that you can. It's just the amenity war continues. It's a contest to how luxurious you can make everything. And the finishes are getting really over the top as well. And the other thing that maybe we're seeing in the luxury properties is think about creative ways to use the common area space. And they're also even approaching it in terms of how could you adapt that in the future. And as you were saying with some of the technology, I mean, does it become obsolete or how does it evolve? So you're certainly approaching it from a design perspective of if I wanted to come in and replace this in 3 years, how difficult would it be to tear this out and do something different? And then just the one thing that I would actually mention that you really see in virtually every new property now that you didn't before is a cool waiting area for your Uber or Lyft to come pick you up. So, and usually they concentrate that in the clubhouse you walk in leasing area. There's just a spot for folks to hang out as they're waiting for their ride share. Clever. And actually it helps you lease to the new people because they see it's an active environment at this property. It comes together really well.
Now, we talk about leases that usually can be 6 months or a year leases. How about these leases that are for 24 hours or 48 hours or 72 hours that are Airbnbs or VRBO type of stuff? Are you seeing that big of an impact in some of these apartment buildings?
Certainly, some owners and operators are starting to experiment with short-term rentals, and certainly encouraging that is where we are in the cycle with delivering a whole lot of new product. And if you could take a floor or two of your property and just take it out of the long-term leasing pool and operate it as short-term rentals until you get your property leased up, that is something that I will say that we're seeing more companies experiment with that and maybe try it at a property or two. I don't know that anybody's jumping into the deep end of the pool there.
So to continue the potpourri section, I guess one of my questions about is we kind of read a lot of the headlines and seen all those corporate reloads. And as of yesterday, I saw that Austin's getting 800 jobs to expand the Amazon, which would have likely gone to the Long Island City in New York. What are you guys kind of baking in the cake for the SALT tax? And so after the tax reform, there's obviously winners and losers in location, and you're seeing the state of New York has, a massive deficit on their budget because all the rich people are moving to Florida and things like that. What's kind of your general thoughts around the whole tax reform SALT and how it's shaken out over the last year?
Yes, the tax reform did maybe change things a little bit, but in the big picture, I think you look at demographics and economic growth and the pattern that we've been on, and that people are just coming to the Sunbelt markets, and those are the places where the jobs are being formed. And so maybe you've tweaked it a little bit with some of the tax structure, and that you've, in some of those really expensive gateway markets, you've minimized the tax benefits of owning. So you're maybe discouraging home sales and keeping people as renters in some of those markets. But again, I think if you're measuring it, you're changing what happens after the decimal point. You're not changing that first number.
Okay. And then, Greg, you go to a lot of conferences. Is there any sort of questions that you're constantly getting from investors? Any common type of questions that we didn't hit on today?
Well, I will share that just yesterday, RealPage had in what we call our steering committee. So these are users who, for each product area that we offer, we have client advisors on each of those. And then once a quarter, we bring them all in and talk to them about what's important to them. So I just had this conversation with our clients yesterday in terms of what's important to you and what do you want to talk about. So they always want an update on the state of the market. Maybe more so than we have seen recently. They're confused by what's going on in the general economy, and are we at an inflection point, and how close are we to that next recession? And then really, really hot button nationally, not so much in select markets, not much so much here in Texas, but rent control. Man, are we starting to talk about that in place to place? And particularly now that Oregon has done the first statewide regulation on rent control, people in the industry are concerned about what that can mean.
Okay. And then if we are getting a little bit late cycle, maybe you can talk a little bit how maybe some of your products also can help owners out there, whether it's tracking stuff or anything like that can help products if there is a recession coming up, anything that can prepare them for it.
Well, certainly, number one is just knowledge and keep abreast of what's going on. A question I asked, again, the steering committee that we had in the room yesterday, to what degree are you playing defense, and what form is that taking? And that can be make your lease length a little bit longer. It can be work on your resident retention and pay attention to limit the churn. What will make your residents happier and stay in place? Look at your expense items at this point. Is there anything that you can do there? Tim, you want to jump in and talk about any of the products that would help us in that direction?
Yeah, absolutely. So, there are certain markets right now where we can't really do asset optimization, or perhaps we also work with affordable Section 8 or HUD housing where they don't have the opportunity to really push rents. So looking down the barrel at Oregon, infecting the rest of the country with that concept is it can be concerning. So one of the other two key areas where RealPage can help people and that we advise them to look at is their cost per operation per square foot, their maintenance, repair, and operational costs. We have a variety of ways we can help drive those costs down. And then the other thing we really have a focus on is mitigation of risk. A lot of people don't recognize that to calculate the risk of your property, you take your occurrence, you multiply that times the frequency and factor in the cost of each occurrence. And then you can actually put together a number of what your calculated risk is. And the way to drive that down is to mitigate that risk through insurance solutions, proper deposits from the residents, given, in low income housing, for example, you mentioned the C-class properties, perhaps doing a surety bond where you have a lower point of entry, but you get better coverage for those kinds of risks. And then one big one we find is just your vendors coming on the properties. They present a risk. So risk mitigation is key. And then driving down your costs for operation and utility management's another huge one where we can, benchmark how much you're recapturing from the residents on water, electricity, that kind of thing, and comparing that to what your competitors in the market are doing.
And Tim, the one thing I would add there is pay attention to the marketing spend. And are you actually reaching the types of people that you want to reach with that? And what tweaking can you do there?
What's been the most effective?
It depends on who you're trying to reach,
Target.
and it's actually very different from one area of the country to another. So
Texas?
there's
Maybe Dallas.
Certainly a big component of what you have to pay attention to here when you're in that Class A luxury space and there's so much new construction, you have to be reaching the affluent people, but really fueling a lot of the demand at that top end of the market are people who are relocating from other places across the country. So, if you're marketing in the neighborhood, well, you're not talking to the right people. You have to be doing it in some form that the person who is moving from New York or San Francisco or any place across the country, if they're coming into Dallas and need to release right away, how can they find you?
So let's kind of wrap up this conversation. James, you've heard Greg a little bit here. What's your 2 cents of what Greg's saying, and if you could explain it and break it down?
Yeah, I think there's still a little bit of runway, but it sounds like you need to be a little bit more cautious for sure, and also look at the tools you're using in terms of your property management and how you're managing these properties, because it's, at some point you just can't keep pushing rents and you can't keep churning the whole rent roll, and you're going to have to keep some of these guys around, and that retention ratio instead of 30 or 40% might need to be 50 or 60% in this market.
Yeah, I think my 2 cents, Paul, would be, not that you asked me, but that you listen, pay attention to what's going on in the marketplace, and then you got to make adjustments to your strategy as you go. It's not a static thing. It's always changing. And, if you're out there buying a lot of people that borrow money from Old Capital and listen to the podcast, you're out buying a bunch of workforce housing stuff at $20,000 a door, and now it's $80,000 a door, and you're going to do the same renovations you did 5 years ago. That may or may not be the most strategic decision to do. So as the market shifts, you should try to anticipate that or see it early on and get ahead of it and reposition yourself and make sure that you're, as Tim's mentioning, pay attention on both it's not just the income, it's the expenses, and make sure you watch it and maybe try to lower your turnover costs and try to keep your a little bit more defensive than we have been the last several years.
Yeah, I'd also make another point talking about setting expectations correctly. If you are an investor looking to buy, evaluate property, a lot of people were with the expectations that they could double their money every 1 or 2 years. I think realistically right now in these value-added properties, whether they're B or C properties, equity is going to have to remain in place for 5 to 7 years. I think that's kind of the new norm that to be expecting for equity. You're not going to have those numbers as we had before. So, longer and for lower. I think that's kind of our theme. Anything, again, Greg, that we didn't cover that you think would be important for everybody to listen to?
One thing I would just point out, and we talked about big markets across the country, some of these secondary markets are actually looking pretty attractive at this point because they haven't had the building and they've still got some pretty solid job growth. So don't eliminate a place just because it's pretty small. Any
resources that you guys put out that the listeners should kind of pay attention to? Any webcasts, publications, anything you want to direct people to? Yeah, we do webcasting where we talk about a market every single week. And the best way to just access any of that is via the RealPage website. And that's just realpage.com, and then /analytics will take you into our blog. And that there's
virtually every day something new goes up on that blog.
So do me a favor, wink at me if you can tell me the top 5 markets that I would invest in. After the podcast, you can tell me, and I can tell everybody else. But we appreciate Tim being in the podcast. Thanks very much, and telling us a little bit more about what RealPage does. I think it's a very dynamic product that people need to have some exposure to, whether it's RealPage or Axiometrics or a lot of the different products that RealPage offers. The human robot, Greg Willett, always a pleasure. You remember Greg, he was at our Old Capital Conference back in September. He'll be coming back for our conference in the fall, so we look forward to having him at our conference. In fact, we'll probably see him up in the San Francisco Bay Area at one of our little meetup meetings sometime in May. So we're going to keep our fingers crossed. We'll coordinate and give you some information on that. The other human computer, James Zhang, thanks for being on the podcast.
Thanks, Paul, for having me.
Smartest guy in the room, Michael Becker, thanks. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.